For the third consecutive time, the Federal Reserve cut interest rates, the central bank dropping its benchmark lending rate by a quarter point. The cut was made over objections from some Fed officials who believe a focus on the higher cost of living should be prioritized. Wednesday's action comes as the economy grapples with continued inflation woes and weak job growth. Fed Chair Jerome Powell, in his remarks, noting the effect of the record-long government shutdown in the decision.
The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening.
And joining us now is local expert Matt Eilers from Medalist Wealth Management. I want to get your reaction first to the cuts here. Of course, this is something that many predicted, I feel like.
Yeah, well, it was a long time coming. It was being talked about and flirted the idea with all year long. And honestly, it was really needed for the economy and for just the environment that we've been in. So I think it was expected, but it was much needed. And really, the Fed is seeing the economy stabilize to a degree that they can ease back on these rates a little bit, especially with inflation cooling. So it's good to see.
Yeah, absolutely. I guess my question is how here at home should we be reacting to this? How does this impact us here in West Michigan?
Well, there's a number of different ways you have to think about, through the lens of saving, spending, and investing. I think one of the big things, especially here in West Michigan, that this is going to affect is the housing market, because we're going to see interest rates come down on mortgage rates. We're going to see interest rates come down on auto loans, on credit card rates, and that's going to change the landscape of affordability for buyers out there. Think about it with the low inventory that we have here in West Michigan in the housing market. You couple that with high interest rates, now bringing the interest rates down, it's going to let a lot of buyers kind of back into the game that were priced out just due to those high payments. So we're not going to see this happen overnight. It's a gradual effect for mortgage rates to come down, for auto loan rates to come down, but the answer is it's going to happen.
Okay, and it might be a nice little sigh of relief for many people looking to get into the home buying market here.
Yeah, what does that mean for people that are looking at buying homes or homeowners that are thinking about refinancing?
Yeah, so obviously with rates coming down, you're going to be able to maybe get more house than what you had before. But if you own a home right now and maybe you purchased it when interest rates were high, and you're uncomfortable with that interest rate that you have, it could present an opportunity for a refinance. But it's really important that you run the numbers. You want to do a break-even analysis because there's going to be things like closing costs involved. But they always say date the rate, marry the house. And it's an opportunity to take a look at, can you better your financial position and take advantage of a rate that's coming downward?
Yeah, let's talk about the savers in general. Now that the rates are expected to come down, what should those savers be looking at right now?
Well, I guess the days that we've been in of these 4 to 5% savings accounts are coming to an end. And we've started to see that over the last 2 cuts that have taken place. But there's been a lot of what I call free money out there in money markets and high yield savings where, you could be making somewhere between 4 and 5%, beating inflation. Those rates are going to decline. So the interest rate decrease is going to affect that. And it's going to create, I think, really a change in your saving strategy about, is it smart to still keep that type of asset in a cash position or in a savings position, or should you be exploring something different? This is where we always stress the importance to any families that we're talking with about having a plan, and always speaking with a professional to kind of just lay out all the puzzle pieces and run the numbers to see how it's going to affect your family.
Yeah, interesting.
Yeah, so there's a lot of people I know that have been kind of putting off searching for homes just because of how rough the market's been.
Yeah.
Would you say now is the time that they can start kind of looking, or is it better to hold off still for a little bit for things to settle?
I think looking is great. I don't think it's too soon to start doing that. I guess the jury's out in regards to how quickly the rates are going to come down. The mortgage rates, they can take a little bit longer to come down than some of the other short-term rates like auto loans and credit card interest and things of that nature. But what I believe this is going to create a lot of other people entering the market just because of the fact that they can afford more now. For that reason, I would be on the lookout just so that you're not last in line to put in an offer, you'd rather be first.
Let me throw this at you. I know we've got a lot of folks graduating college here, getting their first jobs. We've got Grand Valley State University's graduation was over the weekend here, and they're going to start opening some of those savings accounts that we're talking about for those, savers in that category that we were just mentioning. What is your best recommendation for someone just getting into the game now that we're seeing these interest rates be cut?
Oh my gosh, with especially a recent college grad, if you have employment already, start saving for retirement. That's one of the savings accounts I think that you should have. You should get an IRA, or you should get a Roth IRA, or if your employer offers a 401k or a 403b, take advantage of that, because a lot of the times there's free money on the table through like a company match. But if you're looking to just start saving, not in a retirement account, I think it's a good opportunity to talk to a professional about what type of savings looks appropriate for you. Does it make sense to get into the stock market? Does it make sense to get into treasuries, or because if you're exploring getting outside of bank type assets, savings accounts and money markets, things of that nature, I think that's where having a professional opinion to help you understand your level of risk and your time horizon and what you want to be exposed to is super, super important. But there's just a ton of opportunity for saving right now.
And of course, there are different financial situations all across the board, so that might be another reason to maybe get expert advice too.
Yeah, absolutely. And when we're coming up on the end of the year, there's less than a month left of 2025. What would you suggest to people that are seeing that these rates are now cut? What should they be doing before the year ends?
I think this is a really good time to take a look at your debt situation and start to plan strategically about how you can reduce or eliminate that. There could be strategies regarding a HELOC, perhaps, to try and lower high interest debt and consolidate that and eliminate it. There's refinance opportunities that are there. It's a really good time to rebalance portfolios as we approach the end of the year. So if you were wanting to have a 60-40 mix and equities have been outperforming bonds and now you're at 70-30, it's a good time to kind of pull that back. And then also a really good time to make sure you're taking advantage of any of the contributions that are available to you out there in an IRA or a Roth IRA before the end of the year.
Let's talk about stock market investors. I'm sure that there's going to be some sort of impact as we saw the cuts come in yesterday. The stock market was sky high. It soared. So what is your recommendation now that we've got this third consecutive cut for those stock market investors?
Yes. Well, the markets liked the rate cut initially. The jury's out. I don't have a crystal ball that's going to tell me what's going to happen today. But markets respond typically positively to this, but what we can also see is a spike in volatility when interest rates are declining. So volatility is to the degree to which something goes up and down. We could see things move a little bit sharper in both directions, but I think in general, based on the strength of the economy, it's a good time to be in the markets if you're in the right investments and they match your risk profile.
Yeah, let's switch gears a little bit because a lot of things that I've been hearing around these Trump accounts, I want people to make sure that they know what those are. My dad is in banking. He has been talking about this. So for folks at home, what is the Trump account? How can we take advantage of that for the kids at home as well?
Oh my gosh, it's so cool actually. It's Trump Kids Savings Account. Now this is for children that are eligible, or they're eligible if they're born in 25, 26, 27, or 28. This 4-year gap. What's going to happen here is there's going to be $1,000 of seed money from the U.S. government put into these accounts. And then families are able to contribute no more than $5,000 a year up until the child is 18. And what happens is at age 18, this turns into an IRA, a retirement account. So what you've got is $1,000 of free money on the table for children born in this period. Now, any child under 18 can open an account. You're only going to get the $1,000 if you're in that 4-year window. But it's a big deal. And I was running some numbers yesterday, actually, just to help people understand the scope of this. If you open that account for one of those children, they get the $1,000 seed money. And as a parent, if you just invest $167 a month, that's $2,000 a year, up until they're 18, if that account is only growing at 7%, which is very, very reasonable for the fact it needs to be invested in low-cost index funds, that child would have over $70,000 in the account at the age of 18. And if they never put in another penny and just left it invested, they could have close to $2 million at retirement age. And that is just wild to think about, that they could start that journey, as a young child with $1,000 from the government to get them going.
Yeah. All right. Well, Matt Eilers with Medalist Wealth, we always appreciate your time.
Likewise.
Thank you so much for coming in.
Thank you.
All right. It is 8:23. We're back in a moment after this.